Have you ever played Legos? If you have, you know that the Lego bricks come in different shapes, they come in different sizes. It's a game that encourages the player to kind of be creative, innovative in creating unique shapes and sizes. Hi, I'm Harry, and welcome to another Star and Standard Practical Knowledge video. So, why in the world am I starting a video about taxes by talking about Legos? It's because I think that the game of 1040, the process of determining your regular tax liability, is similar to stacking a column of Legos, where you strategically place different thicknesses of blocks in building the column. U.S. Income Tax Form 1040 and its schedules are used to report data to the Internal Revenue Service, the IRS, and to calculate an individual's income tax liability. The image shown here shows what that column looks like. The column begins with recognized gross income, income that's taxable. Certain adjustments are then permitted. Gross income less those adjustments equals adjusted gross income, AGI. You then get to subtract the greater of your standard deduction or the sum of certain permitted deductions. AGI less those deductions equals your taxable income. The taxpayer's ordinary, short-term capital gain, and long-term capital gain rates are then applied to the taxable income to determine the income tax liability. Available tax credits are applied to reduce the taxable liability. Income tax liability less the available tax credits equals taxes due. The key to reducing your taxes due is to have strategically planned smaller amounts of recognized gross income for tax purposes, smaller amounts of AGI, and a small amount of taxable income. But you want larger amounts of above-the-line deductions, the below-the-line itemized deductions, and tax credits. Doing this will help you produce a very small bottom-line tax liability, if any. Okay, let's examine each of the component pieces. The IRS considers any income or other benefit which you receive or have the absolute right to receive as taxable income, unless it's specifically excluded or exempt under Internal Revenue Code. Examples of taxable income include wages, commissions, bonuses, net income from a side business, net rental income, interest and dividends for your portfolio, and capital gain on the sale of assets. The list of taxable income items is quite extensive. What doesn't get recognized as gross income in the current tax year are benefits that have been designated by the IRS as either excluded from income or exempt from taxation in the current year. Benefits that are specifically excluded from regular federal income tax calculation include municipal bond interest, alimony and child support, scholarship for tuition and fees, gifts, inheritances, certain de minimis employee benefits, health care insurance benefits, court-awarded compensatory damages for physical injuries, capital gains on the sale of your personal residence subject to limits, and a portion of Social Security benefits. Income that is excluded from taxation in the current year but will be taxed in a future year include deductible contributions to a traditional IRA, employer contributions, employee deferrals, and portfolio earnings in a traditional tax-deferred qualified retirement plan, the accumulated interest in a U.S. savings bond, earnings within a non-qualified annuity, and earnings within a health savings account, an HSA. Allowable adjustments to gross income include the following: pre-tax contributions to a traditional IRA, contributions to a health savings account subject to a cap, qualified student loan interest subject to a cap and subject to a phase-out, self-employment adjustments, including 50% of self-employment tax and self-employment health insurance premiums, early withdrawal penalties from a CD, other cash equivalent securities. Note, the tax law enacted in July of 2025 allows that tips, overtime pay, and the auto loan interest on U.S. assembled vehicles, subject to a cap, to be deducted from gross income. There are a few other minor adjustments. Gross income minus the above-the-line adjustments equal your adjusted gross income, AGI. Now, AGI, or in some cases manipulations that modified AGI, is important because this number is used to determine eligibility for certain tax deductions, tax credits, eligibility to make pre-tax contributions to a traditional IRA or contributions to a Roth IRA, determination of what portion of Social Security benefits is taxable. Additionally, AGI is the starting point for most state income tax calculations and typically used in the alternative minimum tax calculation. Taxpayers can deduct the greater of their aggregate below-the-line deductions, also referred to as itemized deductions, or the standard deduction. The amount of the standard deduction is based on your tax filing status, such as single, married, filing jointly, head of household. There are 4 categories of itemized deductions. 1, unreimbursed medical expenses that exceed a certain percentage of AGI. SALT, which stands for state and local income, property, and sales taxes, subject to a cap. Qualified interest on home debt, again subject to a cap, and charitable contributions, subject to a cap. Subtracting the greater of the itemized deduction or the standard deduction from AGI equals your taxable income. Taxable income includes ordinary income items and capital gain items. Based on the composition of your taxable income, the progressive tax rate schedule for that tax year is applied to your ordinary income dollars. Short-term capital gain rates are applied to your short-term capital gains, and long-term capital gain rates are applied to your long-term capital gains. The sum of those 3 calculations equal your income tax liability. Now, the tax is tentative because you have one more item to consider, and that is the tax credit. Tax credits reduce the tentative tax dollar on a dollar-for-dollar basis. They are golden. For example, if you had an annual tentative tax of $10,000 and your tax credits amount to $6,000, then your actual tax liability is $4,000. There are a range of tax credit categories, including education credits, family and dependent care, income and work-related credits, adoption, and business credits. The income tax liability amount minus the available tax credits equal your regular tax liability for federal income taxes. Now, the reason I just said regular tax liability is because there's a second calculation referred to as the alternative minimum tax. That tax calculation starts with your taxable income from Form 1040, but adds back or takes away certain write-offs, exempt dollars, and excluded income before applying an AMT standard deduction. From that number, the AMT tax rate schedule is applied. If your regular tax exceeds the AMT, then you simply pay the regular tax. If the A&T liability is greater than your regular tax liability, then you pay the AMT tax liability. Or more technically, you pay the regular tax liability plus that excess AMT amount. The standard filing date for individual taxpayers and their families is April 15th. There is an automatic approval for delayed filing, which is 6 months later. However, you will need to file Form 4868 and submit your projected tax liability payment. In this video, you learned about U.S. Individual Tax Form 1040, understand its components, and how your tax liability is calculated, which offers a roadmap on how to minimize your annual tax liability. Additionally, I hope that the information you learn will promote meaningful discussions with your tax planning professional. Well, thank you for watching this practical knowledge video. I invite you to watch other videos that I've posted on this personal financial planning topic or other relevant pieces of your financial planning puzzle. If you found the video useful, then please tap the like button and consider subscribing to the Star Standard channel. Have a great day and see you in the next video.